is the burden of current pandemic will be felt most by the weaker sections of the society. And it is therefore obvious that the lenders to the bottom of the pyramid will need to prepare themselves for what lies ahead beyond the moratorium. Now, to understand how the microfinance institutions are coping up with the current situation and what is the way forward for them, I have with me a microfinance veteran, Venkatesh N. Venkatesh is the founder and managing director of Samasta Microfinance Limited, an IIFL group company. During his 20 years entrepreneurial journey, he has founded multiple ventures in the areas of financial services, marketing, and wealth management, including the erstwhile PNV Techno Acquisitions and Affluence Edifice, before he founded Samasta in 2008. Now, Samasta has grown to be one of the leading MFIs in the region, with presence in 17 states, 1.5 million customers, and an asset book of over 3,400 crores. Venkatesh holds a bachelor degree in computer science and has completed the Harvard Business School ASEAN program on strategic leadership in microfinance. So very warm welcome to you, Venkatesh, and thank you so much for taking the time out and joining me for this Bank Perspective session.
Thanks, Amit. Nice to connect with you on this platform.
So I'll go straight away into understanding how the situation is. And one thing that comes to my mind is, how do you compare the current situation on account of COVID with what we have seen earlier at the time of demonetization? Of course, demonetization itself was a very big disruption specifically for the microfinance industry. What are the variables which are changing? And when I say variables, I would say in terms of whether the expectation on the portfolio stress, whether the expectation in terms of the timeline of normalization, right? Or in terms of how you're handling the situation through the teams. Is there any contrast there, or the situation sounds similar or more difficult than what you had seen earlier?
Yeah, Amit, the scenarios have played out differently. I mean, to what happened during Demon and what's happening now, per se. I mean, if you look, just to go back to what happened during Demon, we had issues in terms of cash availability. Hard currency was not available. It was very difficult for our end customers to repay our loans, and that actually went into a little tailspin in a couple of geographies, which we had problems for quite some time with that. But in terms of what happened during COVID is as the country went into a lockdown on 24th of March, I mean, the business came into a standstill per se, and we didn't get to the customers for collection, or we didn't meet the customers, but we were in touch with the customers over the phone, trying to figure out how their health conditions or the whereabouts of how their income has depleted, or what are they doing to cope up with the COVID situation. So the customer connect was there in a different form. We spoke over the phone and all those things, but we completely disconnected in terms of meeting in person. So, and also the RBI moratorium has played out in such a way that customers are comfortable. They also know that they can avail the moratorium if they're short of repaying the loans. But it was not the case during Demon. I mean, Demon, most of the companies at that point of time got back to the customers. I mean, many of them didn't know what to do. So they just went about doing their normal collections, which did not happen. And most of the problems got created on the field by vested interests. You can say, like, that actually created a little bit of a problem for us. And though it improved, we had a slack period of some 2-3 months. But as we speak about COVID, it's still, we are in midst of COVID. I mean, as we end August, we actually end the moratorium part of it. If you look at the moratorium, how it's played out, from March 24th, many of them availed moratorium till almost end of May. And some of the customers started paying early June. From June, we started seeing improvement in collections. And collections have come in various forms. We had, I mean, even in May, when we were in touch with customers, some of them wanted to pay up their dues. So we used digital means to collect their installments. And slowly now we are getting back into the normal collections aspect of it, but making sure that social distancing is maintained and all the basic norms are maintained. As you are aware that microfinance is a high touch business in terms of we do meet customers on a regular basis, depending on their the collection frequency being monthly, fortnightly, or weekly.
So hearing you, Venkatesh, one question comes to my mind is in terms of the challenges which COVID has created for us in terms of how we have been used to running the MFI business, which is very, I would say, FOS oriented with relatively high manpower deployment on the field to have touch and feel with the customer. Much of our discipline to ensure that customers pay on time relies on group lending models. So our center meetings become very, very crucial. So these are high touch personal interaction models. And because of COVID, of course, now there is a question mark. How often can we meet the customer? Can we do our regular collections that like we used to do, whether it was weekly, fortnightly, or monthly? Can we do those group meetings and create that social, responsibility that the group was able to create? Now that model would have to transform on account of COVID, whether temporarily or permanently, but the business has to go on. So how do we handle that? How are you handling that? And how do you see the other players in the MFI industry handling that?
See, as I said today, I mean, if you look at the industry per se, it's around 230,000 odd crores, vastly spread across the states of India. I mean, and predominantly across, we are doing the group lending methodology in the microfinance industry. And we do meet our customers regularly, as I mentioned. I mean, we have just made some adjustments as of now, but it is not the permanent model which we also wanted to emerge to. Right now, most of the adjustments have been made to with the protocol of the COVID being around. I foresee this to be a very temporary thing, except the digital cash collection aspect of it, which could be a permanent thing, which will be the way forward. But I mean, definitely we see as in during Demon, we had close to around 90 odd percent of more than 90 odd percent of our collections, 90 odd percent of our disbursement being done through cash. So physical cash was being handed over to our customers. Immediately after Demon, if you look at it just a month or two after Demon, the whole thing flipped into 90 plus percentage of our customers had taken, I mean, we dispersed through their bank accounts. So, I mean, there was a huge change. So I think so the COVID is going to be a turning point, but given the thing which things are taking shape, it will be a little more longer, but I think so everybody has gone back to the drawing board and figuring out what could be the models which they can work within their team. I mean, mostly it is moving towards how digital collections can be enabled. So the way, most of the organizations have already having pilots running, figuring out what are the things which they can do on the ground.
So does it change in terms of, let's say, if we talk about increasing digitization, and especially in the collections and payments is what you are referring to, from an overall cost structure point of view, does it reduce operational costs to a large extent, or do you think that this is only an incremental benefit in all the gloom that we have and not a very significant one?
No, it will definitely add on to a lot of cost benefit, but it will not happen immediately. So immediately we may incur a little bit of cost because there are a lot of models which will be emerging and a lot of transition taking place, but definitely over a period of time, we will see our own field officers will start handling more customers. And the challenging bit is right now we have the joint liability group model running. How do we really pack ourselves or give a security cushion around how we can still have the joint liability group in a very pseudo kind of a format and ensure the collections percentage are high as what we used to have. So that's the challenge which everybody has been raking their brains about right now. Given this kind of a scenario, we are taking in all kinds of ifs and buts into the business plan or reworking our strategy. We have worked on all these cases. A lot of monitoring also used to happen. I mean, if you look at, we are based in Bangalore. We have the whole zonal teams across. And for monitoring purposes, we were traveling extensively across the length and the breadth of the country. This has actually given us a lot of avenue of thinking, actually, which we wouldn't have thought about. I mean, if you look at, we want to keep minimum contact with the customer in terms of moving things digitally and all. So this was an ideal kind of a thing where a lot of thought process was actually channelized. And also many of our customers whom we see are graduating from group lending to individual loans, how we could cater to them much better. So these are a lot of avenues which we were able to brainstorm within our team actually.
One thing that triggers me is in terms of how's the regional comparative. You're spread across quite a few large states. Do you see any difference which is there in terms of how some parts of the country are behaving or likely to be impacted compared to some other parts?
See, the Western market has done well, if you look at it. And if you look at the Southern markets per se, have been quite highly impacted per se by the number of cases out there. So there has been a lot of restriction in movement per se. So given the restriction in movement, we do have the collection percentage also dips thing. But what happened in the East was we did have some slight issues in one of the states. Then floods affected a couple of states. So COVID, affecting it along with the floods actually slowed down our the momentum initially, which we started to build up in June, actually slowed it down in the second part of July. So this is how it's panned out. I mean, things are improving, but beyond all this, if we compare month-on-month basis between June, July, and August, things have started improving across actually.
One more question on the operating model side is what about impact of migration? Because much of the lending, especially for MFIs who are in the urban poor space, do you think that would face some challenges on account of increased migration where people are going back to their natives and there are different reports coming in saying that many of them would want to continue where they are because there is no end in sight of when the pandemic will end. So will that impact or create some kind of a challenge?
Yeah, I mean, see, if you look at, there's a lot of restrictions still on the ground when we go out. So to go about their daily activities, and they're hugely curtailed in their income earning capabilities, especially in the urban scenario. I mean, institutions which have a higher exposure to urban will take little more longer time to get back to the clientele, to figure out how they should handle them, give them some more time to for them to come back to shape. But I mean, given our rural bit of it has come back into action quite early, but the other part which is playing out in the rural is a lot of them had migrated to the urban pockets, and remittance money was getting back to the our rural customers. So they had additional income and they were able to take additional ticket sizes to pay off their loans, which will be slightly tiresome for these customers right now. And but we also see another opportunity is where people who have come back want to start off something at their places, and they would like additional lines of credit. I mean, somebody in their household would have already borrowed. So given that case, so they may require some additional lines of credit for the household so that they can enhance their existing business or draw a new line of business. So, I mean, in rural space, definitely we don't see the recovery will be much faster. Urban, I think so most of the urban dominated players will have to give the customers a little more time. But we are confident that these people also will come back, because bottom of the pyramid customer, I think that they're the strongest and they get back into some kind of activity because life has to go back for them. And we see them coming back into shape very, very fast.
What about the organizational challenges? I'm sure there would have been a lot of adjustment how people are coming to office and how your field officers are going and interacting with customers and how productivity is being monitored, how office space is being utilized. So what are the changes which you have seen there and are happening even today?
See, I mean, unlike other sectors, we just can't work from home. So work from home cannot be an option for us. So, I mean, because given our thing is 90% of our workforce is a field workforce at various hierarchy levels. And we have a very minimal workforce at head office and zonal levels. Beginning of the COVID, we had ensured that our customers are in touch with, we are ensured that we are at all points of time, we had our field officers getting in touch with our customers. So parallelly, we worked with our hierarchy and figured out how the monitoring aspects can be also worked out. So we had various apps being enabled internally itself to have a proper monitoring mechanism and get to the, I mean, at least talk to the customers in terms of how, what kind of moratorium they want to avail, how many months they want to avail, and all those things. But at the head office level, we do have a work from home partly because given our state guidelines that we cannot have 100% at the office. But when we started, we were working in various, we kept changing it. Lockdown 1, lockdown 2, lockdown 3. Right now, what we do is we manage it and above, everybody comes to office. Below that, we have team A and team B who come on alternative days. So it's been quite challenging times given the industry. We have a lot of coordination, lot of thing, but the whole team has coped up with at very short period of time. We were able to get a hang of how we need to change and adapt ourselves.
On this piece, there is one specific input I was looking from you, Venkatesh. A lot of your field staff in particular may be based in tier 4 and below and also in rural areas, right? Has the infrastructure requirement of connectivity, of broadband availability and interaction, which otherwise would have been done through physical meetings, has that been a challenge, or do you think that has worked out well you've been able to manage it to a fair level of success?
I mean, we did, I mean, if you look at all our branches were anyway had a connectivity and we had simultaneously most of our staff were given tabs, not most, all of our staff at field force are given tabs. So they do have a decent amount of connectivity at their places where they stand, except barring a few places. I can say it was less than around 2% of places where we couldn't reach out to data, but they had connectivity over the phones were operational. So, I mean, we didn't have much of a hindrance given the penetration at which telecom penetration, which India has been growing at. So we didn't have much of a problem. But couple of later on in the second part of the thing, just to add on to your earlier point of work from, we did have a couple of our branches being getting into a lockdown because of a couple of COVID cases in our branches, and we had to almost stall operation for almost 21 days. So I mean, we took it to the stride, and even the field force have gotten back after their mandatory quarantine and stuff.
Okay, next question, Venkatesh, is about the employment opportunities. Do you see a lot of job cuts happening? Do you see either on account of the challenges which maybe the smaller players in particular may face, or maybe the operating model, as we discussed earlier, changing, right? Do you see any challenges in terms of large scale, significant job losses happening in the microfinance industry?
So we don't, I mean, given our high customer touch business which we operate in, we don't see any job cuts happening. But if you look at between April and first half of the year, many of them set up new branches, ensure that we get into new geographies, and we would have created more employment per se. That we have not, that's not happened this year. So in that space, I mean, there would be a loss for people who would have been employed in this sector. job cuts per se, we have not seen any job cuts across the space. But the only thing is we employ a huge chunk of people year on year across the industry, which will be missing out in the first 6 months. Maybe we have to see how it takes off in the next 6 months actually.
So what you're saying is not job loss, but I think the impact is primarily on account of the fresh recruitments that otherwise would have been created. Okay, moving on to a little more strategic view, Venkatesh. How's the availability of liquidity with the MFIs in terms of much of the MFI have been supported through the private equity availability in the past? How has been the private equity part of it in terms of access, and not only for Samasta, but in your understanding across the MFI industry, have there been private equity infusions coming in, deals coming in your knowledge?
There's been a great deal of financial inclusion of trust by governments, present government, the previous governments for quite some time. That in turn, if you look at the microfinance industry after 2003, 2004, has seen a considerable amount of growth, and private equity has been flowing in at a decent pace into the industry. And this has helped the growth of the sector to what it is today. And government had subsequently given bank licenses, like Bandhan got license. So that's a big thing for the sector per se. So this has actually opened up a lot of avenues for organizations like us and others to scout for, and we have private equities coming in, seen for well-established, good governance companies with a lot of principles attached to it, has been quite decent. Even during this COVID time, we had at least 2 transactions which took place. And to add on, even if you look at the debt aspect of it, the liquidity lines which were opened up by government has really helped us. But I mean, in some cases now, the small and medium microfinance institutions were also looking at it. I think so. There is considerable amount of work being done by the associations to enable those categories of organizations also get liquidity in terms of debt. I think so. In the coming days, we will see that also happening. But larger organizations like ours have been quite comfortable in raising debt in the last couple of months.
So you're saying a bank support in terms of providing debt to MFIs has been stable, has been good, primarily on account of the government's push. So that's a heartening thing to hear.
That's true. I mean, there is a government had clearly. I mean, if you look at specifically for the microfinance institutions, there was enough liquidity being carved out. That has actually helped the sector in not worrying about pushing very hard for collections or something. They also understood that clients need to take some more time to get back. So liquidity plays a very, very important role in that. And I mean, one of the, I think so, instances we can see that government has understood the sector quite well. It assured that there was liquidity, and in turn, we assured that customers were also given enough time instead of going behind them for collection aspect of it. The moratorium bit was announced well ahead, and all these has helped us quite a bit.
One thing that I noticed, now we are at the fag end of the moratorium, and come September, we are talking about getting the normalcy of the collections. Do you see the portfolio stress rising, delinquencies rising? And a fallout of that may be that there will lead to some bit of consolidation, especially for the smaller MFIs, or a bigger MFI taking a smaller one, or more financial institutions consolidating some of these together.
With aspect to stress, if you look at from June onwards, this is almost at the fag end of August as we speak, collections have been improving consistently. I mean, if you look at across organizations, we see collections improving consistently. So that's actually a heartening sign for us, and heartening sign not only in terms of collections improving, also seeing that livelihood of our customers are coming back into shape. So that's the most important part of it. The livelihood is getting back into shape. Definitely, there would be some kind of, as we get back into complete normalcy in terms of collections, moratorium getting over on August 31st. Yeah, maybe some few pockets, we would see some kind of a stress level being coming up, but fair and large, as long as we understand our customers. So if you look at the training aspect of it, what we did with our field force in the last couple of months, not only with us, across the institutions, people have been more considerate in looking at the situation and try to act accordingly. If you look at the highly rural focused microfinance institutions, I have seen customers bounce back to their livelihood activities very fast. But when you look at urban customers per se, they're taking a wee bit a longer time to get back into their livelihood activities. So we may see, or we will, it will only give a clearer picture as we get to the months of September, October, if there would be any stress levels in our portfolio or not. But in terms of the consolidation per se, consolidation, I think so, had to happen on various cases, even with COVID or without COVID. All of us have signed up a thing called Code of Responsible Lending. After RBI recently raised a group lending cap from 1 lakh to 1,25,000, and we all, including, the sector is divided into a couple of formats now. We have banks like Bandhan, who predominantly work in the microfinance sector, but also other private sector banks, public sector banks also do cater to the microfinance sector. Then we have the small finance banks, which have grown from being a microfinance institution into small finance banks, predominantly, except barring one or two SFBs. Then we have NBFCs who also who are basically into larger asset classes, also cater to the microfinance segment. Then finally, we have NBFC MFIs, which were predominantly to be catering to this class, also targeting the low income households category. Barring, we have few trusts and NGOs also who also have a fairly decent portfolio in a couple of pockets. So if you look at this scenario playing out in full toto, we have only 3 institutions which can lend, and to a total of 1,25,000 under the group lending format. Once this comes into play completely, we can't have too many players operating in a geography. We definitely see mergers happening. We had Credit Access Grameen merged with Madura Microfinance. So, so things will like this will definitely play out irrespective of COVID. With the COVID thing coming on, definitely, if you look at it, we spoke about equity and debt being easily available, but it is not going to chase everybody, or everybody will not have the same access as everybody who's operating in the sector. And when that comes into thing, definitely we see some kind of acquisition part of it also coming to play. It's early days for us to actually predict anything, but as you are envisaging, definitely there could be two aspects: mergers and acquisitions playing out in the sector as COVID settles down and people come back and analyze where they stand actually.
So on that, a corollary to that question would be, what happens to the aspiration with RBI saying that the bank licenses are available on tap? The point has been reiterated multiple times. Licenses were given, as you said earlier, to many of the larger MFIs to become small finance banks. So that aspiration path for MFIs, does it get impacted now, or do you think that path can still be on, or the companies would have to, or MFIs would have to wait and watch and then look at if they would want to get into the banking models where the capital requirements or the operational cost structures or the cultural aspects of how you do business may require fundamental changes?
See, a couple of them are actually were working towards becoming SFBs, or Some of them even have aspirations of becoming a universal bank without getting through the SFB route. So I think so their plans, I don't think so, may not be curtailed, but I mean, most of them will be waiting out how the COVID thing spans out for a couple of months. I don't feel people who had aspirations will not be taking a stop at what they wanted to do. Things will happen, but it may happen at a little more lengthier. The time taken will be a little longer. But I mean, in terms of the institution, I mean, an SFB route or a banking route, the universal bank route could be a good way for covering the complete financial inclusion bit of it, which we aspire to cater to our customers. I mean, because today, if you look at being an NBFC MFI, we are predominantly only catering to one part of financial inclusion. I mean, if you look at it, we need to get into the savings aspect. There are a couple of other aspects of it which we need to cover for our customers, which as a NBFC MFI, we are missing out. I mean, we will also see how things shape out and see not only us, other peers will also take some more time to figure out whether they have to take up that route.
So that's a good news and heartening to hear, Venkatesh. And I thank you for taking the time out and speaking to Frank Banker, sharing your perspective with the industry and the banking fraternity at large. Thanks once again for joining me.
Thanks, Amit. Thanks for having me on. Looking forward to meet you in person again.